Very good evening to all of you. Welcome to another YouTube live session with me, Srijit Kakkar. Today we will be talking about options payoff graph, right? It is called with different terminologies. You can call it as the payoff graph, you can call it as the risk profile, you can even call it as position graph. So today we are on lesson number 11, and this is what we'll be understanding today. What is this position graph or the payoff graph? Now, if you have not gone through the previous lessons, make sure you go through the previous lessons. The link is available in the description for both English as well as the Hindi lessons. And the options course is an absolutely free course. And I'll also like to add, if you're liking these sessions, yes, make sure you hit the thumbs up button. If you're still not subscribed to my channel, also make sure you subscribe to the channel so that whenever I'm doing the next lesson, you get notified for it. And also click on the bell icon and select all notifications. And let's get started with today's lesson, which is lesson number 11. And today we'll be understanding the payoff graph or the risk profile or position graph, whatever terminology you want to use. So before we move ahead, let's get done with the formalities. Make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So today we are on lesson number 11, like I already said. And again, I'll repeat, I'm doing these sessions, the options course, both in English as well as in Hindi. The link to the playlist is available in the description for both of them. Because if you have still not gone through the previous lessons as we move ahead, when I refer to some previous lessons, or if some of the concepts are still not clear, it can be a little bit challenging. So do make sure you have covered all the lessons. So today, like I said, we'll be talking about the position graph. So this is how a position graph looks like. Now, what does a position graph does? A position graph represents the profitability of an option position at expiry, right? So it tells us that at expiry, what will be the outcome of a particular position which I have in the options. Now, if you look at this graph, this is basically a graph of buying a call, right? If you think about it, when we talk about buying a call, right? We buy a call. So call is a positive correlated unit, and buying gives you the right. And whenever you're buying, you will be paying some premium, right? So this, and now we understand that whenever you're buying options, the maximum loss you can have is the premium paid. So this is what this graph is showing me, that probably you paid a premium which would be this much, right, for this option, which is maybe around 400 rupees would have been the premium. So in case it keeps going down, if the prices they keep moving down, you can see if the prices keep moving down, your risk is limited to the premium you paid. Sorry, this is the price, this is the value, right? So the maximum loss will be somewhere around 9 rupees, my bad, right? So this is where you have your your I think I have created this graph incorrectly. Anyways, so whatever the value might be, so that's the maximum loss you can have, which is the premium you paid. And you can see no matter how low the value goes, so definitely this is the profit and loss. So yes, you would have paid 400 rupees as the premium, and this is the value. So in case the value goes from 9 rupees to 8.5 rupees to 8 rupees to 7.5 rupees, now this is where what I'm saying, that there has to be some issue, because seems like this is not based on the value. Maybe it is based on percentage or something, because if the value is such a small value, the premium cannot be 400, right? But let's ignore the numbers for a minute, right? So let's ignore the numbers for a minute. What this is telling you is, in case the prices they keep going down, my risk is limited to the premium I have paid. And in case the prices they start moving up, my profit can be unlimited. And that is the payoff graph of a call option. So this is what the graph basically does. It shows you the profitability of an option position at expiry. Now, position graphs helps us understand the behavior of an options play and to identify any unusual characteristics. And at expiry, we understand the options, they do not have any time value, right? So that is why we can try to understand what can be the outcome of an option trade if I'm holding it till expiry. Now, whenever we talk about calls, whatever strike price we are buying, right? So whatever the strike price is, so your strike price plus your premium will be your break even point. Because if I'm buying a call, right? So let's say I buy a call which is let me change the color, which is 200 call, right? And let's assume for this 200 call I paid a premium of 10 rupees. So what is going to happen, uh, I have bought a 200 call, right? And the premium I paid is 10 rupees. So if the price goes to 210, now my intrinsic value of this option is 10 rupees because I have the right to buy it at 200, even though the current market price is at 210. So now the intrinsic value is 10, and that is what I paid for this trade. So my strike plus premium is always my break even point. Now as soon as prices go to, let's say, 211, so now this would be 11, I paid 10 rupees, so now I have a profit of 1 rupee. If they go to 220, so now the intrinsic value is 20, and because I paid 10 rupees, now my profit is 10 rupees because 20 minus the premium I paid. So for a call, your strike price plus the premium is your break even point because call is a positive correlated unit. Puts are negatively correlated units. So in this case, what is going to happen? Strike minus your premium. Now again, if I sell a in fact, if I buy a put, if I buy a put which is 200. Now, buying a put basically means we are expecting prices to move down because puts are negatively correlated. So it's more like a short position. So if the prices, now again, if I paid 10 rupees for it, if the prices they go to 190, now the intrinsic value is 10, which is equal to the amount which I paid. If it goes to 180, now the intrinsic value is 20, 10 is what I paid. So now I have a profit of 10 rupees. So always remember, for calls, your strike price plus premium will be your break even point, and for the puts, your strike price minus your premium will be your break even price. And the position graphs, they help us visualize three key considerations. The first one would be, what is the maximum risk? Now what happens is, when you look at the graph, immediately we get to understand what is the maximum risk we have on that particular trade. Similarly, it also tells us what can be the maximum reward, and it also tells us where can be our break even point. So when we look at the graph visually, immediately we get to know what is the maximum risk, what is the maximum reward, and what is the break even point. Now, you need to remember, whenever you are long options, be that a call or be that a put, right? So, whenever you are long options, your net profit will be the intrinsic value minus premium paid. Why? Because if you think about expiry, at expiry, time value will be zero, right? So the only value you'll be left with would be the intrinsic value, right? So if it has some intrinsic value, let's imagine you have an intrinsic value of 100, and because you bought an option, you would have paid some premium. So that intrinsic value minus whatever your premium was. Let's imagine your premium was 10, which means now you have net profit of 90 rupees because this was your intrinsic value, this was the premium you paid. Similarly, when you talk about selling options or writing options, so whenever you're short options, writing options, or selling options, your net profit will be the premium received. Because again, if you think about it, when you sell options, the maximum profit you can have is the premium you received, right? So premium received minus the intrinsic value would be your profit. And that is why, if you remember the last session, we talked about, whenever we are selling options, we would like to sell options which do not have intrinsic value, because if we are selling out of the money options, intrinsic value will be zero and I get to keep the complete premium. So this is why, when buying options, we want to buy something which has intrinsic value, so that at the end of the day we are losing less. And whenever we were selling, we talked about we want to sell out of the money. But yes, in case of long options, intrinsic value minus the premium is your net profit, and in case of shorts, your net profit will be the premium received minus the intrinsic value. Now, intrinsic value helps long traders, right? That is why in the previous lesson we talked about, whenever we are taking long trades, we want some intrinsic value to be there. And similarly, for a short trader, intrinsic value will hurt. That is the reason we always want to choose strike prices which are out of the money when we are selling options. So this is what we discussed even in the previous lesson, which was what strike price to select and what expiries to select. So now you will be able to understand it even better when once we start getting into these position graphs. So let's now understand how these position graphs are created. So let's imagine for a minute that I buy a 100 call at 8 rupees, right? So let's just imagine that we buy a 100 call. So 100 is your strike price and we are buying it at 8 rupees. This is your premium and this is your strike price, right? So now I know my strike price, I know my premium. So what we are doing is we are trying to understand what would be the net profit and loss at expiry. Now at expiry, this stock can be at any price. right? It can be at 130, it can be at 120, it can be at 150, right? Wherever. So let's assume that this stock on expiry is at 130. So if it is at 130, what is the intrinsic value at expiry? So buying a call gives me the right to buy it at 100 rupees. Current market price is 130, which means I have an advantage of 30 rupees, which is called as the intrinsic value. So the intrinsic value is plus 30. But whenever you are buying a call or you are buying a put, right? So whenever you are buying options, you are basically a debit trader. Money is going out of your account, right? And how much money in this case went out of my account? It was 8 rupees. So what is going to happen is this would be minus 8, because that is what I would have paid for it. So what is my net profit and loss? Like we talked about, whenever you are buying, your net profit and loss is the intrinsic value minus the premium paid. So intrinsic value is 30 minus the premium paid, which is 8 rupees. My net PNL would be 22 rupees. Now let's assume that this stock closes at 120. That is the price on expiry. If it closes at 120, now my intrinsic value would be 20 rupees, because my strike is 100. We are 20 rupees above. So intrinsic value is 20. My premium would still be the same, right? Because that is what we paid. So minus 8, which means 12 rupees. Similarly, if this stock closes at 110, now my intrinsic value is 10. It will be debit 8 rupees, which means 10 minus 8 would be 2 rupees. Similarly, if it closes at 100, so my intrinsic value now is 0, because 0 is uh, I mean, because we are closing exactly at the strike price, we paid 8 rupees. So what is going to happen is it is going to be debit 8 rupees, and my net profit and loss would be 0 minus 8, which means I'll be losing 8 rupees now. If it closes at 90, right now, what is going to happen is, because the intrinsic value cannot be negative, right? That is what we learned when we were doing the previous lessons, that the intrinsic value is always 0 or a positive number. So since the intrinsic value cannot be a negative number, therefore in this case, again, my intrinsic value would be 0. Because we paid 8 rupees for it, my loss is now limited to 8. Similarly, even if it goes to 80, this is going to be 0. We paid 8 rupees, and we are again losing 8 rupees. So can you see, my loss is limited to 8 rupees no matter where the prices they go. But my profit is unlimited. If it goes to 140, it's going to be another 10 rupees, which is going to be 32. If it goes to 50, it's going to be 42, right? So my risk is unlimited, my loss is limited. Now, understanding, if I only say, okay, I buy a call at 8 rupees, yes, we do understand what we are doing. But if we look at it on a graph, can you see, we immediately understand what this would mean. Now, just as an example, where would the script have to close at expiry for break even? Because we paid 8 rupees. If it closes with an intrinsic value of 8 rupees, I will be at break even. So my break even price will be 108, because now my intrinsic value is 8. I paid 8 rupees. So the answer to this question, where the script have to close at expiry to be at break even, it has to close at 108. That is where I will be at break even, because you can see at 102 I'm making 2 rupees profit. At 108 I'll be exactly at break even. Now when we look at the same data on the chart, it becomes much easier for us. So here you can see this is my PNL, right? So this is minus 5 rupees, minus 10 rupees, plus 5 rupees, plus 10 rupees, plus 15, 20, 25. So this is where you have your PNL, and this is where you have your the price of the stock, right? So you can see the stock can be at 80, can be at 90, at 100, 110, 120, 130. So now what we are doing is, at these price levels, we are just plotting this graph. So you can see at 130, I would be making 22 rupees. So at 130, this is 22 rupees, this is 20. So just a little bit above is 22. At 120, it's going to be 12. So this is 10. At 120, we were at 12. At 110, we were making 2 rupees. 110, we were making 2 rupees. At 100, we were losing 8 rupees. At 100, you can see now we are losing 8 rupees. At 90, again, we are losing 8 rupees. At 80, we are again losing 8 rupees. Now, no matter where the prices they go, our loss will be limited to 8 rupees, and my profit is going to be unlimited. So can you see, just saying buying a call might not give us the clarity that what is the risk profile or what is the payoff graph, but when we see it visually, we immediately understand the outcome of this option play at expiry. Now I understand that the maximum loss I can have is just 8 rupees, and my profit can be unlimited, and that is what this position would do to me. Now let's take another example, a little bit more, I won't say complex, but yes, one step ahead, just to recap this and understand it even in a better way. So let's imagine that what I'm doing now is I am buying Reliance at the current market price. So I'm buying the stock, right? And along with that, I am also selling a 2000 call, right? So again, if I just tell you buy Reliance at current market price and sell 2000 call, you might not understand what are the characteristics of this position. But let's now do it as a graph and see what are the characteristics of this position. So what I'll do is I'll bring up an Excel sheet, because this can also be done in an Excel sheet. It's not that you need any specific software. Let's take an Excel sheet and let's see how this can be done. So let's assume I am buying a Reliance at the current market price. So what is my CMP? So let's say current market price is where I'll be buying Reliance. And if you look at your current market price for Reliance, we have it at uh, 1947.50, right? So that's the current market price. Now we are also saying that along with this, we are selling a call with a strike which is 2000. So what is my strike price? Strike price is 2000, right? So now let's try to create a payoff graph or risk profile or a position graph for this position. So first thing will be, what is my stock price? Let me do this. Stock price at expiry, right? Now, at expiry, the stock will be at certain price. Let's take different values. Let's say 1600, 1700, 1800, 1800. Right. So let's take it till, let's say maybe 23, 2400. Or let's take it till 2300. So can you see the stock can close at any price on expiry, right? It can be 1600, 1700, 1800, 1900, 2000, 2100, 2200, 2300, whatever, right? So that is the price at expiry. Now, the next thing will be, what will be my intrinsic value if it expires at this price? So let's do this. Intrinsic value at expiry. So what will be EXPIRY, right? So what will be my intrinsic value at expiry? So if you are buying a 2000 strike, right? If you are buying if it is a 2000 call, right? And it is expiring at 1600. So what is going to happen? If you're talking about this, your intrinsic value is going to be zero, because uh, at if you look at it, you bought at 2000 and currently in the market you can get it at 1600. So this call has no benefit to you, right? So if you talk about intrinsic value, how is intrinsic value calculated? It is your uh, price minus your strike. Now, because this cannot be a negative number, so what I'll do is I'll just put in a formula that if this minus this is less than or equal to, because it cannot be negative or negative, so if it is less than or equal to 0, then I just want this to be 0, right? And I also want this to be constant, and just in case if it is more than 0, then I just need the value, right? So this is what I've done. And if I just now put it on other cells, so you can see if it is if the stock is closing at 1600 on expiry, we have intrinsic value 0, 1700 intrinsic value 0, 1800 intrinsic value 0, 1900 is also 0, 2000 is also 0. But if it closes at 2100, now I have an advantage of 100 rupees for a call, because if you think about it, uh, a call gives you the right to buy at 2000 now, even though the current market price is at 2100, which means I have a benefit of 100 rupees for the call buyer, right? So for the call buyer. Similarly, at 2200, the call buyer will have an intrinsic value of 200, and similarly at 2300, it will have an intrinsic value of 300. Now, the next thing is, what is the debit or credit for taking this position, right? So let me just bring up, oops, my bad. Let me just bring up this. So can you see if I am buying a call which is at 2000, you can see the current price is 3 rupees 60 paise, right? So I'm just talking about this month's expiry, which is expiring on 26th of November, which is tomorrow. So let's assume if I am looking into this call because I will be selling this call, right? I'm not taking long a call, I'm taking short a call because I'm shorting this call. I will be getting 3 rupees and 60 paise, right? I'm not paying because we talked about we are selling it, right? So by selling, I will be getting a credit of 3 rupees 60 paise. It's going to be a positive number. And all these would remain 3 rupees 60 paise because this is not going to change. 3 rupees 60 paise. Now, the next thing is let's see what is going to be my PNL for the option for this option trade. So this option trade or this options position PNL would be, this is what I have received, right? So this is going to be equals to this minus my intrinsic value, because if you remember, we talked about uh, what is the net profit. Your net profit is the premium received minus your intrinsic value. So what is going to happen, because here intrinsic value is 0, I get to keep this 3 rupees 60 paise. Here again it is 0, I get to keep 3 rupees 60 paise. But as we keep moving down, because now it has intrinsic value of 100 rupees and I only collected 3 rupees 60 paise, therefore I'll be losing 96 rupees and 40 paise. In this case I'll be losing 196 rupees and 40 paise. In this case I'll be losing 296 rupees and 40 paise. So this is the PNL of my options position, right? So currently we have only taken the options position, but this has two factors. One is the option position, the other one is we are also long on Reliance. So what is going to be my stock PNL, right? Stock P and L, right? So if the stock closes at 1600, then what is happening is I am losing because I bought it at the current market price minus the expiry price. So just give me a second. All right, so it is gonna be my just a second. Let me just perfect. So this is gonna be my again the equals to the uh, expiry price. So let's imagine we are expiring at or at expiry the price is 1600 minus my price at which I bought that stock. Right, so this is going to be minus 347.50. And similarly, if we keep going down here, I'll be losing 247.50, 147.50, 47.50. Then we'll be losing 52 rupees. I mean, we'll be making 52 rupees 50 paise, 152.50 paise, 252.50 paise, and 352.50 paise. So that is going to be my profit and loss on the stock position. This is going to be my profit and loss on the options position. So what is going to be my net PNL? Net P and L. So my net PNL will be this plus this, right? This is going to be, oops, equals to this plus this. And now if you look at your net PNL, you can see that this is going to be your loss. And this is going to be your maximum profit. So what I can see just from this is that my loss can be unlimited, but my profit will be limited. So if I draw a graph for this, the graph would be something like this. I select this and I select this, and then I go to my home, insert. I guess I need to go to insert, and if I bring up uh, perfect. So can you see if I bring up this now, this is showing me my PNL graph, that if the prices they keep going down, my loss can be unlimited, but if the prices they keep going up, my profit will be limited just to this price, which is 51.6. That's the maximum profit I can have on this trade. Now, if I bring up this graph, you will see it's exactly the same thing. So currently, if I just show you the graph of a short call, so what happens is, in fact, let me also add the other one as well. So we also wanted to go long stock at the current market price. So if I show you the graph first of a long stock, so can you see now, just visually we understand if we buy a stock, if it keeps going in our favor, we have unlimited profit. If it starts going against us, we have unlimited loss. So that's the position graph of buying a stock. Unlimited profit, unlimited loss. Now, if I change this to just the graph of going short a call. So can you see whenever we go short a call, our risk is unlimited, because if the price keeps on increasing, we'll keep on losing money. But what is the maximum profit? The maximum profit is the premium we have collected, and here you can see the premium we have collected is 3 rupees 60 paise, and that is what it is showing me here at the bottom. Just give me a second. Here you can see at the bottom that the maximum profit I can have is 3 rupees 60 paise. But as and when the prices keep going lower, you can see this value is changing, because now my loss will keep on increasing. So as and when the value keeps on increasing, you can see my loss is increasing from 3 rupees 60 paise to now at 13 rupees, now at 54 rupees, now at 168 rupees, now at 333 rupees. So this is the position graph of selling a call. So can you see, now I showed you the graph of selling a call, I also showed you of going long a stock. But if we are doing both of them together, so this is what we got even from our Excel sheet, that is how the graph would look like. And what is this graph telling me? This graph is basically telling me that the maximum profit you can have is 51 rupees and 60 paise. Let me again bring this up for you. So you, oops, my bad. So you can see the maximum profit I can have is 51 rupees and 60 paise, because if it keeps going higher and higher, I'll not be making any more money on this. That is what this position graph is telling me. But in case it starts going against me, I can have unlimited loss. That is what this is telling me. So this is why we use payoff graphs or the risk profile or the position graph, because they visually help us understand uh, what is the characteristic of the position which I'm getting into, right? So it is showing me the characteristic is limited profit for unlimited risk, right? That is what the characteristic is. And if you talk about this limited uh, limited profit for unlimited risk, this is also something which would be a position graph of. If I do this instead of short put, you can see short a put also has exactly the same graph. Can you see? Shorting a put is exactly same as selling a call and buying, selling a call and buying a stock. So can you see, this also has exactly the same position graph, that your reward is limited but your risk is unlimited. So again, we were talking about selling a call. So short call and long stock, and that's the risk profile. So this is what risk profile is all about. It basically helps you visually understand what can be the outcome of this trade, depending upon where we are expiring, whether we have limited risk, whether we have unlimited risk, whether we have limited profit, whether we have unlimited profit. Plus it also tells you where is your break even point. Like here it is telling me that my break even point is right here, and that break even point is around 1900 and 46 rupees 85 paise, right? So here you can see, and this is where it will tell me my break even point. Though if it just moved, let me put it again here. Can you see, if I'm putting it here, I'm trying to go exactly at zero, though I'm not at zero, because you can see if the cursor moves 1 pixel here, 1 pixel there, it keeps on changing. So I'm trying to get it as close to zero as possible. So can you see, now we are almost at zero. So my break-even point would be 1943 rupees and something paise. So this is what this position graph helps you with. The risk uh, what kind of risk are we taking? Are we taking limited or unlimited risk? What kind of reward we can get? Is it limited or is it unlimited? Plus, what is going to be my break-even point? That is also what you get to know on the chart. And like I said, you can even do it on Excel sheet. I just showed you how it can also be created on an Excel sheet. You can create your graphs here if you wish to. And that's the topic for today, which was the position graph or the risk profile, which basically helps us understand what are the different outcomes of the position which I'm taking in an if I'm using options combined with, let's say, stock, if I'm using multiple options. So that is what we get to know. So that brings us to the end of today's session. Thank you so much for joining in. I hope this has been helpful. In case you have any questions, queries, you can definitely put it in the comment section. I'll answer them as soon as possible. I'll also be doing the same lesson in Hindi probably on Friday. Till then, trade safe, enjoy your Wednesday evening. Take care. Bye bye.